The trade war between the United States and China, which began in 2018, has become one of the most influential and long-lasting economic confrontations in modern history. What started as a dispute over tariffs, intellectual property theft, and trade imbalances quickly evolved into a strategic struggle for global technological and industrial supremacy. Both nations have sought to reshape global supply chains, secure critical resources, and assert dominance over future-defining technologies such as semiconductors, artificial intelligence, and blockchain. By 2025, this rivalry has extended far beyond traditional trade boundaries, influencing digital currencies, geopolitical alliances, and even the architecture of the global economy. While the United States aims to preserve its leadership in open market innovation and dollar-based financial systems, China's state-driven approach emphasizes technological self-reliance and the expansion of its digital influence through initiatives like the Digital Yuan and the Belt and Road Framework. This multi-dimensional conflict continues to shape how nations approach trade, technology, and digital sovereignty. Deep analysis. U.S.-China Trade War. 2018 Right-Pointing Arrow October 2025. With a focused look at blockchain, crypto impacts below is a comprehensive, chronological and thematic analysis from the start of the trade conflict in 2018 through the October 2025 flare-up. I call out the most important facts, the mechanisms that created winners and losers, and a focused section on how blockchain, crypto have been and are likely to be affected. I cite the most load-bearing public sources for the key claims. 1. Short timeline and turning points. 2018 Right-Pointing Arrow October 2025, 2018-2019. Tariff opening salvo and escalation. The U.S. launched Section 301 tariffs, steel, aluminum, then broad lists of goods, and China retaliated with equivalent tariffs. Supply chain risk and business uncertainty spiked. Jan 2020. Phase 1, deal. A partial truce. China pledged extra purchases of U.S. goods and some IP, market access commitments. Many tariffs remained in place and COVID disrupted implementation. 2020 to 2024. Gradual strategic decoupling and tech controls. Even when tariffs were stable, the U.S. broadened export controls and entity lists targeting Chinese tech, semiconductors, telecoms. China pursued self-reliance in chips, batteries, and AI. 2025, accelerating broad tariffs, export controls, and rare earth countermeasures. In 2025, the conflict re-escalated. Large new tariff proposals, increases, expanded U.S. chip export controls and blacklists, and China tightened rare earth and other strategic export licensing, producing acute supply stress in key tech inputs. By October 2025, Chinese rare earth exports showed steep monthly declines, heightening global concern. 2. Core mechanisms of impact. How policies translated into economic outcomes. Tariffs, right-pointing arrow price effects and trade diversion. Tariffs raised effective import prices, squeezed margins, and pushed firms to reroute production. China right-pointing arrow Vietnam, India, Mexico, ASEAN. That produced near-term pain in bilateral flows but also a redistribution of manufacturing. Export controls, entity lists right-pointing arrow tech choke points. Where tariffs are blunt, export controls target the technology stack, advanced nodes, lithography, EDA tools. These actions slowed China's access to cutting-edge chips and accelerated domestic substitution plans, but they also forced allies to coordinate tech controls for effectiveness. Resource leverage, rare earths and processing. China's dominance in processed rare earths creates strategic leverage. Restrictions or licensing tighten the supply for EV motors, magnets, defense tech, and some specialized electronics. Recent export declines in September 2025 demonstrate the leverage's immediacy. Policy-driven reshoring and subsidy races. The U.S. and allies responded with subsidies, CHIPS Act-style incentives, and industrial policy, creating long-term competition but requiring huge capital and time. 3. Macroeconomic and trade outcomes through October 2025 bilateral flows. Net declines and reorientation. U.S.-China goods trade is down versus pre-2018 norms. China redirected demand to other regions while U.S. sought supplier diversification. Short-term export declines to the U.S. have been pronounced in 2025. Inflation and corporate margins. Tariffs and supply disruptions added input costs and inflationary noise. Many firms initially absorbed costs, then passed them to consumers. Investment and capex. Both sides increased strategic investments in chips, batteries, and onshoring, but capacity and human capital bottlenecks make this a multi-year process. 4. Who won and who lost? 2018 right-pointing arrow October 2025, short versus long-term short-term, economic resilience, China. Better able to cushion shocks via FX policy, industrial coordination, and redirecting trade. In 2025 it retained leverage via rare earth controls. Medium, long-term, strategic, tech leadership, contested, conditional advantage for US plus allies. If the US and partners succeed in onshoring advanced fabs, building alternative supply chains, and continuing allied export control coordination, they can erode China's dominant positions, but this requires time and billions in investment. 5. Focused section. Blockchain and crypto. 2018 right-pointing arrow October 2025, A. Direct supply chain effects for blockchain infrastructure hardware inputs, ASICs, GPUs, semiconductor nodes, mining rigs and high-performance nodes depend on semiconductors and components whose supply has been constrained by export controls and by China's rare earth processing dominance. That raised capex and slowed build-outs for mining farms and edge hardware in 2024-2025. Mining hardware manufacturers outside China gain some demand, but scaling is hard and slow. B. Geographic redistribution of mining and hosting. Post-China mining migration, 2021 to 2023, continued into 2024-2025. Hash rate and mining capacity dispersed to Kazakhstan, North America, Latin America, and China +1 countries. But cost pressures, hardware, freight, licensing, and energy rules reshaped where new capacity landed. See regulatory and strategic effects on crypto markets. Safe haven versus risk-off. During acute trade shocks in 2025, crypto behaved as a mixed safe haven and risk asset. Many tokens fell with equities, but Bitcoin occasionally showed flows from FX investors seeking non-sovereign value stores. Overall volatility increased and institutional flows paused. State digital currencies and permissioned blockchains. China advanced its CBDC, ECNY, and leveraged permissioned blockchain projects, BSN, to maintain payment sovereignty and digital infrastructure outside open crypto markets, strengthening state control over digital value rails. That bifurcation, state CBDC, permissioned versus open crypto, deepened in 2024-2025. De-risking, sanctions circumvention, and geopolitics used as workarounds. Some actors explored tokenized settlement or private chains to route trade or payments, avoiding traditional rails, but practical scale and sanctions risk make this limited and risky. Open crypto remains surveilled and regulated. The larger geopolitical trend is instrumentalization of digital payments, CBDCs, trade-linked tokenization, rather than wholesale migration to public crypto. E-winners and losers within blockchain, crypto losers. Miners and hardware-dependent players facing higher hardware costs. Startups dependent on cross-border hardware supply. Exchanges overexposed to regulatory risk in China, US jurisdictions. Winners, opportunities. Projects focusing on interoperability, sovereign, permitted chains for governments, firms building local manufacturing for critical hardware, and jurisdictions offering stable, clear regulatory regimes that attract institutional crypto capital. 6. 5 high-impact scenarios, 2025 right-pointing arrow 2027, and what each means for blockchain escalation. Tariffs plus export bans widen. Supply bottlenecks intensify. Mining capex collapses temporarily. Private permissioned chains for strategic trade gain urgency. Public crypto markets likely volatile and down. High risk for hardware-heavy projects. Partial de-escalation and managed competition. Tariffs eased but tech controls remain targeted. Investment in domestic fabs continues. Blockchain firms adapt via diversification and localization. Public crypto recovers gradually. CBDCs expand. Allied export control success, coordinated tech containment. China accelerates domestic replacements. Global bifurcation of tech stacks deepens. Blockchain ecosystems split between Western and China-aligned rails. Interoperability becomes strategically important. Resource shock, rare earth disruption, hardware plus EV plus defense sectors scramble. Blockchain hardware faces higher scarcity, miners face steep margins pressure, token markets react to macro shocks. Regulatory crackdown, capture. China or the US impose strict rules that limit cross-border crypto activity. Growth shifts to friendly jurisdictions. Stablecoins and permissioned ledgers become dominant in regulated trade corridors. 7. Tactical recommendations. If you're an investor, builder, or policymaker, for investors, traders short-term, weeks, months, hedge exposure to hardware suppliers and exchanges with heavy China exposure. Monitor rare earth data and semiconductors export control headlines as high-impact triggers. Medium term, 1 to 3 years. Favor projects with regulatory clarity, sovereign or enterprise demand, CBDC integrations, permissioned chains, and hardware suppliers diversifying manufacturing. For blockchain builders, operators diversify hardware suppliers and inventory, spare parts, alternative ASIC, GPU sources. Design for fragmentation. Plan for possible cross-chain, cross-jurisdiction operability. Implement fallbacks if access to some cloud, hardware providers is restricted. Engage with regulators. Build compliance tooling. Pursue partnerships with jurisdictions offering regulatory clarity. For policymakers, balance controls with supply resilience. Targeted export controls must be paired with investments in domestic supply chains, rare earth processing, fabs, to prevent self-harm and market shocks. Support research and open standards for blockchain interoperability to avoid hardened digital silos that harm global commerce. 8. Bottom line. Concise verdict. 2018 right-pointing arrow October 2025. Economically, short-term, China has shown resilience and retained tactical leverage through resource controls and domestic policy tools. Strategically, long-term, the US and allied bloc may secure advantage if they successfully rebuild advanced tech supply chains and coordinate export controls, but it's a slow, capital-intensive path with uncertain payoff. Blockchain, crypto. The conflict accelerated structural change, hardware scarcity, geographic reallocation of mining, bifurcation between state-led permissioned rails, CBDCs, BSN, and open crypto. Winners will be those that anticipate fragmentation, secure local supply chains, and offer interoperability. Losers will be players stuck on single-source supply or in regulatory gray zones. From 2018 to 2025, the US-China trade war evolved into a multifaceted contest for technological and financial dominance rather than just tariff disputes. Scenario 1. Managed coexistence, 45% probability. Both nations maintain competitive tension but avoid full decoupling. Trade tariffs remain selectively applied, supply chains diversify, and both sides engage in periodic negotiations. Blockchain development continues on parallel tracks. The US promotes decentralized finance and private innovation, while China advances state-led blockchain integration and the digital yuan. This scenario sustains global innovation but with fragmented standards. Scenario 2. Technological decoupling, 35% probability. The trade war hardens into a digital and technological split. The US tightens export controls on AI, chips, and crypto mining hardware, while China accelerates domestic tech independence and promotes its blockchain infrastructure through the Belt and Road Initiative. This leads to two parallel blockchain ecosystems: a Western model emphasizing decentralization and individual privacy, and a Chinese model centered on state control and interoperability within the digital yuan framework. The global blockchain landscape becomes bipolar, fragmenting liquidity and cross-border adoption. Scenario 3. Strategic reconciliation, 15% probability. Economic fatigue and mutual dependency drive a partial thaw. A new trade framework emerges by 2026, focusing on cooperation in climate tech, AI governance, and digital finance. Blockchain becomes a shared platform for transparent supply chains, trade verification, and ESG monitoring. This scenario promotes interoperability, standardization, and institutional adoption, benefiting global blockchain growth and trust. Scenario 4. Escalation and economic fragmentation, 5% probability. trade tensions spiral into an economic confrontation involving sanctions, currency manipulation, and cyber conflict. Blockchain adoption accelerates regionally as both nations seek financial insulation. China intensifies digital yuan rollout in allied markets, while the US leans on dollar-backed stablecoins for dominance. The global economy faces higher volatility, and blockchain's role as an alternative settlement layer grows, but at the cost of geopolitical division. The US-China trade war has proven that global economic competition is no longer limited to goods and tariffs. It now encompasses technology, data, and digital infrastructure. Both sides have endured economic costs yet gained strategic advantages in specific areas. The US strengthened its high-tech alliances and private innovation, while China accelerated domestic industrial independence and digital expansion. As of 2025, the world stands at a crossroads. Whether the next phase brings cautious cooperation, sustained rivalry, or deeper fragmentation will define not only trade patterns but also the evolution of emerging technologies such as blockchain and digital finance. Ultimately, the trade war has reshaped the foundation of globalization itself, transforming it from an era of interdependence into one of strategic competition, where economic power, innovation, and digital control are inseparable.